Assalamu alaikum. Assalamu alaikum and a very happy Eid Mubarak to all. Continuing with the previous lecture. In this lecture, in the last lecture, we talked about the cost which should be recorded when we are recording acquisition. Here we'll be talking about depreciation. Once the asset we start using it, the useful life of the asset decreases. So in that case, we need to record depreciation. Depreciation is not a process of valuation. Book value, causes of depreciation, physical deterioration, and obsolescence. And then we'll be learning about methods of computing depreciation, straight line method, and depreciation for fractional period. And our focus will be half-year convention. Okay, what is depreciation? Depreciation is the allocation of the cost of plant asset to expense in the period in which the services are received from the asset. When we purchase a plant asset, we record it by debiting the plant asset and we credit accounts payable or cash or whatever it is. So once we start using it, so we need to, the life of the asset decreases. So when we purchase the asset, we have a certain cost incurred. We estimate the useful life of that asset. Let's say it will be useful for, let's say, 5 years, 10 years, or so on. As the year passes, the life decreases. So what we need to do is we need to allocate the cost of the plant asset to expense in the period in which the services are received from the asset. Now let's understand this definition through pictures. So the cost of plant asset when it is acquired will be reported on the balance sheet under asset as plant and equipment. Once that asset is placed in use, so we'll start receiving service from it. So we need to remove the cost of the plant asset, a portion of the cost of the plant asset, and record it as a depreciation expense on the income statement. I hope the definition is clear. So now, continuing, when we record depreciation, we are not actually trying to find the valuation. So we call it, it's not depreciation is not a process of valuation. We are not trying to find the market price. We are just allocating the cost to expense. Then causes of depreciation, there are two of them. One is physical deterioration and the other is obsolescence. In order to understand physical deterioration, let's consider that a business builds up a new building. And after the completion of the building, for certain reasons, the building is not more, they are not using that building for a couple of years. Even though the asset is no more in that asset is not used since its construction, but it's going to deteriorate physically because of the weather exposure, weather condition exposure. Sun rays are falling, rain is there, cold and hot weather is there. So this will be will cause deterioration in the physical structure of the building. So we need to record depreciation. And there are other assets that are technological based. So although physically they might be useful for 10 years, but because of the technological advancement, they can only be used for, let's say, 3 years, 4 years, 5 years for revenue generation purpose. So that means it need to be depreciated only for 5 years then. In that case, if the useful life is 5 years, although physically they might be good to be used for 10 years. So what is actually book value? Book value is equal to cost minus accumulated depreciation. The word accumulates mean to add them. So depreciation, accumulated depreciation is the sum of all the depreciation recorded so far. So what does accumulated depreciation represent? It's the contra asset account. And secondly, it represents the portion of the asset cost that has already been allocated to expense. Let's suppose that an asset costs 10,000 with no residual value and 5 years of useful life. So each year is going to depreciate by 2000. The first year, the amount of accumulated depreciation in the account would be 2000. Next year, we'll have 2000 for the first year and 2000 for the next year. So total would be 4000. In the third year, it's going to be 2000 for the first year, 2000 for the second year, and 2000 for the third year. So accumulated depreciation in that case will be 6000. So now methods of depreciation, we have two broad categories. One is straight line method and the other one is accelerated depreciation methods. As we can see in the graphs, so for the straight line method, we have equal amount of depreciation charged in each of the 5 years. But in the case of accelerated method, the first year depreciation is the highest. Okay, then it is lower in the second year. Third year, it's even lower. Fourth year, it's even lower. And fifth year, it's the least. So how are we going to calculate depreciation? Okay, so depreciation expense per year will be equal to cost minus residual value divided by years of useful life. So when we purchase an asset, we have certain costs incurred. At that time, we estimate the useful life of the asset, and at the same time, we estimate that once the asset is used for the estimated useful life, what is the price we'll get if we sell it in the market? So that's the residual value or salvage value. Now let's solve this example. An asset is being purchased on January 1, 2007 at a total cost of 24,000. Residual value of this equipment is 3000 and the useful life is 5 years. So that means this asset will have depreciation expense under straight line method of 4200 per year. So now let's see how this is a depreciation schedule. In the first year, we will have depreciation expense debit and accumulated depreciation credit of equal amount. And we'll have accumulated depreciation balance of 4200. And from 24,000, we minus 4,200, we are left with 19,800. In the second year, again, we'll have same amount of depreciation expense debit and credit in the accumulated depreciation account. But this time the balance of the depreciation, accumulated depreciation would increase by 4,200 and it would be 8,400. Now, what we can do is, so from 19,600, we are going to subtract 4,200 and we will be left with 15,200. Or what we can do is from 24,200, from 24,000, we are going to minus 8,400, which will give us 15,600. So this is how we continue. Next year we have same amount of depreciation expense debit and accumulated depreciation credit, that is 4,200. But now accumulated depreciation balance increased to 12,600 and our undepreciated balance, that is the book value, decreases to 11,400. So what we see is each year accumulated depreciation balance increased by 4,200, whereas the book value decreases by 4,200. And in the last, we have book value equal to residual value or salvage value. This is a test that we have calculated everything appropriately. So now this is done step by step, which we have just seen it in the previous slide. Okay, and I hope that's clear, so I'm not spending much time here. Now, in this example, let's solve this. So, on January 2, 2011, this corporation has acquired a new machine with an estimated useful life of 5 years. Okay. And the cost of this equipment is 40,000, whereas the residual value is 5,000. We need to prepare a complete depreciation table, which is also called depreciation schedule. And we have to do it by straight line method. So let's see in this case. So what we have done is in the previous, in the example, we have 2011 as the first year. So in here, what we'll do is we'll have 2011 here. Okay. We have 40,000, which is the cost. So 40,000 minus 5,000 divided by 5, which gives us 7,000 as depreciation expense. Since depreciation expense and accumulated depreciation are equal in the entry, so I have skipped that column. And we have now accumulated depreciation balance, which will be 7,000, and the book value will reduce to 33,000. Next year again, we will have 7,000. So this is 11, 2011, and this is going to be 2012. We'll have 7,000, and then we'll have 14,000, 7,000 plus 7,000. But this time, 33,000 minus 7,000 gives us 26,000. So similarly, we'll continue over the next 3 more years. So in the end, we have book value equal to residual value or salvage value. I hope that's clear. Now, when an asset is depreciation for fractional period, when an asset is acquired during the period, depreciation in the year of acquisition must be prorated. It must be recorded for the period which the asset has been used. So we have two methods, which is a half-year convention method, and the other one is nearest whole month. In the half-year convention, in the year of acquisition, we record depreciation expense for 6 months. We ignore the date of purchase and we just straight away record depreciation expense for 6 months. Even for an asset which is purchased in February, we'll record 6 months of depreciation. And even if an asset is purchased on 1st of December, we'll record depreciation for 6 months under half-year conventional method. So now in this example, uh, we have to use half-year convention and straight line method. Okay. And the equipment we have to calculate on December 31st, 2007 for the equipment which was purchased on 2007. So here the cost is 75,000. Useful life is 10 years. Okay. And estimated residual value is 5,000. So we can see, we need to calculate depreciation for the first year. So it's going to be 75,000 minus 5,000 divided by 10, which gives us 7,000 for a full year. And in case of half year convention, this would be equal to half of this amount, which is going to be 3,500. Okay. Now here we have to calculate the asset was acquired on 1st of September 2008. Cost is 1,08,000 and the useful life is 5 years and residual value is 8,000. Okay. We need to prepare complete depreciation schedule beginning with 2008 under, and we'll do it for assuming half a convention method used with straight line method. Okay, so let's see this. So here we have 1,08,000 minus 8,000 divided by 5 into half, which gives us 10,000. And we have 10,000 as accumulated depreciation. We have 98,000 left. Next year, we'll have again 1,08,000 minus 8,000 divided by 5, but this time it's not going to be half. It's going to be for depreciation charge for the entire year. So it's going to be 20,000. Accumulated depreciation will increase from 10,000 to 30,000, and whereas the undepreciated cost will reduce by 20,000 and we'll have 78,000. So this is how we are going to go about. Okay, now if you see that we have completed the fifth year, but at the end of the fifth year, we do not have book value equal to the residual value. We have book value 18,000 and the residual value is 8,000. In this case, we'll have an additional year added and record depreciation for remaining 6 months. Whereas, see, what we have done is actually we have recorded depreciation for half a year, 1 year, 1 year, 1 year, 1 year. So that means 4.5 years of depreciation has been recorded. So in this case, what we'll do is we will have to move into the sixth year and record depreciation for the remaining half year. So we complete 5 years, and in this case, we'll be left with 8,000 book value, which is equal to the residual value. I would like this question to be solved by you, okay, in order to learn half-year convention method. In case of any query, do place it on group. Thank you very much. Jazakumullah khair.